What's up guys, my name is Nick and welcome to my channel. Today I'm going to take a look at straddles both from the long and short perspective. Before we get into the video though, do me a huge favour, smash the like button and subscribe to the channel, it helps me out a ton. I'll see you on the other side, cheers. There are essentially two types of straddles, long and short. Long straddles are set up by buying an at-the-money call and an at-the-money put. Short straddles are essentially the opposite. Rather than buying the two options, we sell them. The call and the put options should be based on the same underlying, Apple stock for example. Additionally, the expiration date of each option should be the same, and also the strike price of both the put and the call. Since a long straddle requires the purchase of the options, the position is established for a debit. When opening a short straddle position, on the other hand, we receive money, or what is known as a credit. Let's take a closer look at each strategy. A long straddle is indifferent to the direction in which the price of the stock moves. Can be either higher or lower, but in order for the strategy to be profitable, the stock must move a long way from the option strike, and the quicker it moves, the better the position will perform. The opposite is true for a short straddle. A short straddle is a price neutral strategy that benefits when the range in which the stock trades is contained around the short option strike. The diagrams show the payoff for both the long and short straddle positions. The blue line in each case shows the perfect expiration. The orange line shows the expected payoff one day after implementing the trade. Let's take a look at a concrete example and break down the numbers. So recall, a long straddle is the purchase of an at-the-money call and an at-the-money put. In our example, Apple stock is trading at $113 per share. We can purchase the 112.5 strike call for $8.55 and the same strike put for $7.45. When we construct a straddle based on the 112.5 strike, then the net debit, or the amount of money we need to pay for the straddle, is $16 or $1,600 per contract. Our maximum profit is unlimited, since in theory there is no upper limit to how high the stock price can go before the options expire. The loss, on the other hand, is limited to the amount that we pay for the straddle, or $1,600. Remember, for a long straddle to make money, we need the stock to move away from the option strikes. But how far exactly? We can calculate the break-even price by adding or subtracting this debit from the option strike price. The lower the break-even point, or BEP1 then, is 112.5 minus 16, or $96.50. To the upside, the break-even, or BEP2, is 112.5 plus the $16, or $128.50. So, the long straddle is profitable when the stock price trades either below 96.5 or above 128.5 by the option expiration date. If the price remains inside this range, the long straddle loses money. So recall, a short straddle is the sale of an at-the-money call and an at-the-money put. Again, Apple stock is trading at $113 per share. We can sell the 12.5 call for $8.55 and the same strike put for $7.45. When we construct a straddle based on the 112.5 strike, then the net credit, or the amount of money we receive for the straddle, is $16 or $1,600 per contract. Our maximum loss is unlimited, since in theory there is no upper limit to how high the stock price can go before the options expire. The profit is limited to the amount that we sell the straddle for, or $1,600. Remember, for a short straddle to make money, we need the stock to stay within a range. But again, how wide is that range? We can calculate the break-even price by adding or subtracting this credit from the option strike price. The lower break-even point, or BEP1 then, is 112.5 minus 16, or $96.50. To the upside, the break-even, or BEP2, is 112.5 plus the $16, or $128.50. So the short straddle is profitable when the stock price trades between 96.5 and 128.5 by the option expiration date. If the price moves outside this range, the short straddle loses money. So, let's summarize the trader's view based on the selection of either a long or short straddle position. A long strategy is price indifferent, but large moves are required in order for the strategy to be profitable. The stock price needs to be very volatile. Since the range that the stock needs to move outside of is quite large, there is a lower probability of success associated with a long straddle position. This, however, is compensated for by the higher potentially unlimited rewards. A short straddle, on the other hand, is a range-bound strategy. Since the range that the stock needs to stay inside is quite large, there is a higher probability of success associated with a short straddle position. There is, of course, a higher potentially unlimited loss associated with the trade. Now let's take a look at the straddle Greeks. If we take a look at the following table, we can see the sign of the Greeks for each of the long-short calls and long-short puts. The Greeks for the straddle are just the sum of the relevant parts then. The long straddle Greeks can be found by summing the long call and long put Greeks. The short straddle Greeks can be found by summing the short call and short put Greeks. So what are the important takeaways here? Well, note that initially straddles, both long and short, when constructed at the money, are delta or close to delta neutral. This is because the individual call and put deltas are of a similar magnitude but of opposite sign, and so they effectively cancel each other out. However, this delta can rapidly change as the stop price moves away from the option strike. Note that the long straddle holder is long or has a positive gamma. This means as the stop price moves down, for example, he accumulates more and more negative deltas and the size of his position becomes larger and increasingly negative. The position builds in his favour and in the direction of the stop move. The reverse is true for the short straddle holder. He is effectively becoming longer stock as the stop price falls. This is the major benefit of holding a long straddle position. The long gamma means wild moves in the stock help the long straddle holder. However, note that there is a catch. A long straddle holder is short or has negative theta, so the passage of time hurts. The straddle needs to move quickly or the effects of time decay can negatively impact the long straddle profit and offset the gains as a result of any changes in the stock price. Wild moves in the market and an increase in volatility help the long straddle holder, since the position is long or has positive vega. The reverse is true for the short straddle holder. In summary then, long straddles should ideally be placed when implied volatility is low. This means that option premiums are lower and so the break-even points are close to the option strikes. Rising volatility during the course of the trade will benefit the long straddle holder. When volatility is high, option premiums are expensive and so the range over which a short straddle holder will be profitable is wider. Falling volatility during the course of the trade will help the short straddle holder. A long straddle has defined risk and the maximum loss is equal to the premium paid. The profit potential, however, is unlimited. The opposite is true for a short straddle holder. This undefined risk and potentially unlimited losses means that short straddles are highly capital intensive. A long straddle requires large moves in price away from the option strike price in order to be profitable, whereas a short straddle position needs prices to remain within a well-defined range for the strategy to succeed. There is a risk-reward trade-off. Long straddles have a lower chance or probability of being profitable, but they also have a much higher potential return. Guys, if you made it this far, you made it to the end and your support's very much appreciated. Again, if you enjoyed the video, do me a huge favour, smash the like button, subscribe to the channel, and I'll see you on the next one. Take it easy. Cheers.